Deposits, deposit strategy, strengthening deposit relationships, all of that is front and center in 2023. The best deposit strategies this year are those that are tiered, targeted, segmented, and strategic, which is to say, do you have a very fine understanding of exactly which depositors at your bank are disproportionately meaningful for your liquidity as a bank? And what are you doing with and or for those particular depositors? Are you communicating with them proactively? What are you communicating? Are you waiting for them to reach out to you with a decision about whether or not they're going to move their money? In addition to that, the banks that are going to fare best this year with their deposit strategies are those that are not confining themselves to the old usual tools of a savings account rate and a CD rate. The banks that are performing the best right now in this environment are those that are bundling savings accounts and CDs in new and creative ways that reach a really nice middle ground so that the bank establishes or garners the liquidity it needs, but also gives a marginally better rate to those depositors who are absolutely important to that particular bank. So those particular strategies that are proactive, that understand the deposit base in a very nuanced way, that act on that, and that are creative with the tools that you have to make those deposit relationships stickier are the ones that are going to really fare well this year. While the speed of money movement certainly contributed to and expedited the runs on both Silicon Valley Bank and Signature Bank, the speed of money movement did not cause those runs. What caused those runs was the speed with which information now travels, runs through the herd, spooks the herd. In the particular example of Silicon Valley Bank, when you combine relaxed regulation with bad risk management and even worse PR, and you do that in front of an audience, a niche audience of venture capitalists who literally trade on the perceptions and misperceptions of value in companies through the same social media channels that bring us conspiracy theories and all manner of disinformation, what you get is a bank run at lightning speed, and one that can be really difficult to contain. So the takeaway from this run is that we now have to consider new facets of concentration risks that are unique to particular niches served by particular banks. In order to gauge your particular bank's sensitivity to rapid deposit outflows, bank directors need to be asking a very short series of questions to bank management, bank leadership. Number one is, how often and how well are we communicating our stability as a bank to our customers, to our market, and to our prospects? Number two is our deposit strategy. Is it targeted? Is it tiered? Is it segmented? Is it strategic? And finally, number three is, have we successfully translated our relationship-based business model into the digital context? That relationship-based business model is what brings stickiness to those deposit relationships. So if you haven't done that in a digital-first era, like the one in which we are living and breathing, you are vulnerable to those very fast deposit outflows. The most important thing for bank directors and bank executives today to understand about faster and real-time money movement is that you can't dip a toe in those waters until and unless you've solved for real-time fraud, because with real-time payments comes real-time fraud. In order to solve for real-time fraud, you have to ensure that the right systems with the right data are communicating in real time with each other in order to be able to identify anomalous patterns, fraud of various kinds in real time so that you can shut those down in real time, or at least give either the originating party or the receiving party of those transactions the option to shut those transactions down before they settle finally to the core of the respective bank.